Hello folks, this is Raj Sastry from Raj Option Trading. Today is May 31st, 2021. I want to talk about stock and option purchasing ideas for the week of June 1st, 2021. Here we'll talk about low volatility strategies. And when it comes to low volatility strategies, you got to make sure when the volatility is low and the RSI is low, that's when you buy either stock, buy call option, buy call spread. You could do these type of things. And also when volatility is low, you got to be a net option buyer. That's when you buy things like strangles, straddles, condors, etc. Because you are not paying too much money because it's volatility is low at this time, so you're not paying too much money. And also when volatility is low and there is a high RSI, that's when you can buy put spread, basically above the stock price. So these are several strategies. We'll look at a couple of these in this video and take it from there. So here I got a stock chart for Anaplan, ticker symbol plan. As you can see here, implied vol is low, 33.1 at this time, and RSI is also low, trying to pick up. Stocks like this are good candidates, for you to even buy the stock outright because stock has fallen off after the earnings, or you could buy call spread. And even if you're not certain about the direction, you can also do buying strangle, straddle, etc. So with that, let's look at some of these strategies and dive in. So here I got a chart of stocks here. The way this is organized is I got the ticker symbol here and the company and the price, market cap, some of these fundamentals here. And then I also have sales growth. As you are a buyer of options and stock, you got to make sure there's a good sales growth. I got 5-year, 1-year, quarter over quarter sales growth here. And also you got to make sure you got good margins. I have got gross margin, net margin here. That tells you companies fundamentally solid, when the margins are high. And then I also have debt to equity ratio. The debt to equity ratio tells you how much money company is borrowing versus its equity. So a high debt equity ratio is a red flag typically. So in many cases, you can see here high debt to equity ratio. In some industries, it's pretty common to have high debt to equity ratio. For example, energy, utilities, and some of these sectors. And then we got ROE, which is return on equity. I want to make sure there's a good ROE. It tells you the profitability of the company. Then we got RSI. As you do fundamental analysis around the sales, net margin, gross margin, to look at the good entry point, you got to look at RSI. When the RSI is low, that tells you, hey, it's a good time to enter and buy. But when the RSI is really high, meaning overbought, above 70 or so, then it's not a good idea to buy the stock, even though fundamentals are good. That's when you kind of use your judgment. Fundamentally sound company, it's over sold, means RSI below 50. That's when you enter and buy. But fundamentally great company, but it's right now it's overbought, meaning RSI above 60 or 70. That's when you don't buy the stock at that time. Even if you buy in low quantities. Then I also have institution ownership here. A high institution ownership tells you, company's rock solid, big fund managers are buying the company. Then short ratio, it's really short of float. You got to make sure, you have to pay attention to this. When the short is high, a stock has already fallen off the cliff, that's when you can, buy the stock, hoping for a squeeze here. But when the short is high, stock is already above, almost at the 52-week high, and RSI is also high. That's when you don't, buy at the time. You want to wait for a little bit cool off. Price to sales ratio indicates whether the whether from a valuation perspective is it too high or not. For example, we got right blockchain a little bit high on the valuation perspective. We got marathon, same story. You got to watch out and make sure price to sales ratio is a little bit meaningful, not too high. IV percentile. In this chart, I made sure all the IV percentile here is below 50 because as a as a buyer of stock, call or call spread, or even net buyer, you got to make sure IV percentile is relatively low. Then we got volume here. It's in thousands. 8051 means 8 million shares traded. I want to make sure there's a good amount of stocks traded. Then we got earnings here. Sometimes you got to pay attention to earnings. Typically around the earnings, IV shoots up, implied volatility rank shoots up. Then we got 10-day, 1 month, 3 month, 1 year, 5-year performance that will tell you how the stock is performing. And last but not least, we also have how much it's off from its 52-week high. That will give a good indication that are you buying the stock or option at a 52-week high, or are you buying at a lower point. So with that, let's dive in here. At the top, we got Discovery, Whip Shop. Discovery, as you can see here, they have good gross margin. Company is making money. They got a little bit higher debt. Stock, as you can see here, by looking at this, you get an idea. 10-day, 10% off. Down performance perspective. 1 month, again 14% down. For 1 year, they've done 46%. They're down 59%. So if you are a options trader, this may not be a right stock for you because company is not doing great. If you buy option here, even though thinking it's cheap, you might lose your money because options buying has got some the theta decay, meaning as you keep your option till the expiry date, if the stock is not doing well, you lose the entire premium that you paid. So that's why you got to make sure stock is a little more volatile. It kind of goes up and down versus stock staying at the same price. So then we got a couple here, Whip Shop, Riot. As you go through this list, I highlighted few stocks here. For example, Fastly, ChargePoi, Anaplan. So these are the candidates, that you can look at to buy, call option or call spread, or even stock for that matter outright. So let's look at one example here with Fastly. For that, I'll go to Thinkorswim platform here. So Fastly, as you can see here, stock is doing pretty okay right now, trying to make its way higher. As you can see here, at this point it is below its 50-day, 25-day, and 9-day moving average. From an RSI perspective, RSI is trying to go up slowly but surely. RSI is here trying to go up. As you can see here, on the balance volume is trying to go up slowly. And from a DMI perspective, directional indicator perspective, right now stock is kind of trying to get into a positive territory. The width or the distance between the red line and the green line, blue line is decreasing. Blue line is trying to make its way higher. The red line is trying to make its way lower. At some point, I can see a crossover where the blue line will cross over the red line. That's a bullish crossover indication. And as you can see, our implied vol is low. This is when we want to be net buyer of the option. There are various option strategies that you can employ here. We'll look at a couple of them here. And from a check-in money flow perspective, I think it's pretty stable. There's a small downtick here. I think you don't need to worry too much about this. Normally, when the stock is a little bit low like this, check-in money flow shows a downtick. I think it's okay at this point. It's a good trade to take. So with that, I could also see here there is a 2-day, weekly, and monthly squeeze on this Fastly. So we could take a quick look at that. Look at John Carter's trade squeeze indication here. So I got here squeeze indication, as you can see here. Fastly, I don't see a squeeze here. I think it's sometimes the indication could be a little bit off. So if you see here, I don't see an indication per se. Let's go back here and let's go to the option chain here, because we want to buy the option. As you can see here, stock is $47 right now. All-time high is 136. And if I just collapse this here, looks like there are calls and puts. There are calls traded is 34,000 calls traded, puts traded is 14.086. So more calls are traded than puts here. That's a good indication. That's why put to call ratio is 0.044. So I think normally number of calls traded more is a good indication. And also, as you can see here, VWAP is 47.94. That tells you stock is trying to get to a little bit higher price than the current price. There is some upward momentum. um, IV percentile, as you can see here, is low 3%. So that's why we want to be option buyer here. So with that, let's look at maybe say 109 days out. So stock is at $47. If you want to buy a call spread, I would probably do if you're very conservative, you could do 40-50. You'll not get too much money for that. Let's try 40-50. You'll not make too much money. So with the 40-50, you're not too bad. So you're paying $5.10. You're making it's a $10 spread. The remaining $4.90 is your profit potential. Almost you're making one to lose, risking one to make one. So if you see here, you pay 510, that's your max loss. You make 490. If the stock stays above 45.10 by this expiration date, which is September 21, you will kind of break even. I think it's a good trade, conservative play, almost make your double your money type play here. So you could confirm and send here. The other strategy you could also do, you could even widen out a little bit. You could do 40-55. That will give you a little more bang for the buck. So if you do that, it's a $15 wide spread. There you go. So in this one, it's a $15 wide spread. You're paying $6.73. It's really little more than doubling your money type trade here. So with this, you're paying 673 to make 827. So it's a little bit bigger profit potential. Your break even is 46.73, which is just below the current price. So it's a it's also a good trade. You'll make a little more money. But if you want to buy option outright, you could do delta 70. So right now delta 74 is good enough. You could just go buy this call option here. You'll pay $10.55, but your profit potential is infinite. As stock goes up, you'll make money, but if the stock goes below 50.55, you'll start incurring losses. So that's why you got to be careful selling the call option just by itself. Don't do a lot of quantities. You could do maybe a little bit less quantity depending on your account size. So this is another option. So folks also try to do things like call ratio spread. That's also a good idea. Your stock is at 47. You could do call ratio spread also here. As an example, you could do similar strategy here. You could buy back ratio spread. You're buying two. You're buying in this scenario. You're buying two 45s and selling 140. So in this scenario, you're paying 44.63 as a confirm and send here. Your break even if the stock goes above 54, your max profit is infinite. If the stock shoots up, you'll make money because you're buying more calls than puts. And as you can see here, if I give me a quick second, I'll close this. So if you look at this here, you are buying 245. So if you look at 45 here, 45 is $7.45. If you look at the mark, it's about $7.52. That's what you're paying. So you're buying two, but at the same time you're selling 140 140 call. So you're selling this at $10.42. what you're doing is, you are kind of betting stock will go up. You don't want to risk too much money. That's why you are selling one at a lower price and bringing more money in here, and use that money and finance, buying the two calls at 45. So that way, if stock goes above the break-even price here, which is 54, your profit potentially is unlimited. So this is one way to play. Many people like this idea because they are sure on the direction of the stock, so that's why they take the directional bets. So normally, if you're a beginner, I would not recommend taking the directional bet like this. You could do just simple call spread like we talked about. And other things you could do is, really, if you don't know about the direction, you could also do things like, because it's a low implied wall, you could even buy a straddle or a strangle. As an example, stock is at 47. You could go to the nearest strike price, maybe 45, and you could do 45. A straddle here. If you do a 45 straddle, you'll pay $12.75, um, as you can see here. But as stock goes up or down, for this to work, stock has to go down, very significantly. Um, so right now, as you can see here, break-even price is 32. On the lower side, if it goes below 32, you'll make money. On the higher side, if it goes above 57, you'll make money. The reason is you're already paying about around $12 here. It should go up and down $12 by expiration date, which is 17th September. So this is the other idea. It's for a strangle buyer, you got a lot of patience, because on a day-to-day basis, it does not make too much sense. You are hoping for the volatility to go up, significantly, and stock to move up or down significantly. Buying a straddle is a good idea for very volatile stocks that can go up and down significantly. So that's another idea. One more idea could be, buying strangle. For that, you could, it's strangle is a little more cheaper than straddle, so you could do buy strangle. So as you're buying a strangle here, as you look at the price here, stock is at 47. Sorry, 47. Yep. And you could buy a call option here. You could go a little higher if you want to. You could buy a call option around 50, so that way you don't pay too much money. There you go. And put option, right now stock is at 47. You could go a little lower. You could say 45. So this is a little bit cheaper than straddle, as you can see here, and you're paying 1,055. Your max profit is infinite. As the stock directionally goes up or down, you don't really care, but it has to go up or down drastically. Your lower break-even price is 34.45. If the stock goes below 34.45, which is about around more than $10 down, or if the stock goes above 60, then you make money. Otherwise, you will end up losing the money. So this is the other way to play. But for a beginner, I would not recommend these strategies. Stay simple. Go with the spread or a outright purchase of the call. So with that, let's jump in and look at one or two more here. So charge point, as you can see here, $24 stock, and there is some expectation Biden's new plan, infrastructure plan, will have some options or provisions to put more charging stations for electric vehicles. If that's the case, even though there is right now sales is $0, it can do well. As you can see here, implied wall is 44, which is on the lower side. $3 million stocks traded. As you can see here, stock is trying to go up. In a 10-day period, 11% up. So there's a chance that this has shifted. It's really showing some positive trend here, even though 1 month, 3 month, 1 year it's down. So if you think Biden's plan will have some options here, stock is really down 51% from 52-week high, you could buy some spread here. So for that, let's go to ChargePoint. So as you go to the chart of ChargePoint here, as you can see, stock is showing some signs of progress. I mean, there's a little bit positive trend here. On the balance, volume is trying to stabilize, trying to go up slowly. Um, RSI is kind of going up and down at this point. And here DMI is showing some bullishness. I can see the blue line crossing over the red line. Anytime blue line crosses over the red line, that's a positive indication. Stock is trying to get to the bullish territory here. Volatility, as you can see here, very low. 43.7 percentile, compared to where it was. As you can see here, high vol, high volatility, high volatility. Right now it's at a little bit lower most volatility, as you can see here. Then as you can look at here from a check in money flow perspective, it's kind of flat to down a little bit. So that way I feel like there is some momentum for the stock by looking at the RSI here and also DMI. So I could see some squeeze. I will ignore that for now. And let's go to option chain here, charge point. I would go maybe 172 days out. That's good enough. And if you look at the stock price is 24 right now. All-time high is around 49.48. We could do a spread here, stock at 24. I could buy 20-30 spread here. So 20-30 spread. There you go. So I'm paying $3.59 for the spread. If I confirm and send, it's a $10 wide spread. So remaining portion is really my profit potential. You're making more than double here. So if you see here, you're paying $3.59 to make $6.51. Almost you're more than doubling your money easily. And break even if the stock price stays above 23.59. So right now it's a conservative play. I think this is a very good trading idea. You could go ahead and confirm and send this. But if you want to buy the stock outright, I mean you could do that too. It's at a lower price, or you could buy the call option outright, say delta 70 somewhere here. You could buy this option outright. So you could just sell a single call, something along these lines. Your profit potential is infinite. Stock has to stay above 27.05, which is a little bit above current price for you to break even. This is another idea. Third idea, charge point is really, it's a stock moves wildly, as you know. So what you can also do is, you could sell a 25 straddle, buy a 25 straddle here. So that's also a good idea for stocks like ChargePoint, which goes up and down drastically. You don't know which way it will go. This is another good idea. But ChargePoint, because it's so low and there's some catalyst, probably this is not recommended at this point, and you could ignore that for now. Next, we'll look at a couple more, maybe one or two more. We've got Apache, HollyFron. Even Anaplan is a good one too. We can look at Anaplan. It's also one of my favorites. Stock has fallen off of late. So Anaplan, it's into SaaS, software as a service play. They got a great software. As you can see here, earnings, stock fell off. These are some good time to buy call option or even a stock outright. Anaplan is a great stock. If you're a stock type person, you could buy the stock outright. IV percentile is low, 33.1. As you can see here, DMI, the red line shot up here mainly because because of this stock drop here. Right now I think it doesn't make sense to look at the chart too much, but one thing you can see is really on the balance volume is ticking up. That's a good sign. People are buying into it. Check-in money flow is ticking up. That's also a good sign. Smart money is moving in. But given stock has dropped a lot, you can ignore DMI. That's typically the case. When stock has dropped so much, DMI, you should ignore because it will show the bearishness at the time. And also I see the RSI ticking up. That's also a good sign. So with that, let's go into the chart here. I mean option grid here. So As you can see, $51 stock, and you could do 45-55 spread here. So you could just go sell the spread, sorry, buy the spread 45-55. There you go. You're paying $4.90. It's a $10 wide spread. Remaining $5.01 is 10 cents is your profit potential. You're doubling your money. So, basically risk one to make one. So as you can see here, you're making $5.10, risking 490 to make 510. That's a good strategy. You could confirm and send. If the stock stays above 49.90, which is below the current price, by 19th November, you will make money. So it's a good risk reward ratio here. And many people love this stock Anaplan. You could even buy a Delta 70 call right here. You pay $10.80. And if you buy stock, you have to pay $51. Here you just pay maybe 1/5 of the price. You could just confirm and send here. If the stock stays above 55.80, which is about $5 above, $4 above current price, you will make money. You'll break even. Otherwise, you will lose. You start losing your money. This is a good strategy also. But if you're a beginner, probably you want to start with the earlier strategy, which is a spread strategy versus buying call option outright. We'll probably look at one more here just to see what's going on. Apache, as we look at Apache here, that could be a good one. It's in the energy segment, and $20 stock, and RSI. The IV percentile is low. It's 8, and it's 13% off of 52-week high. And Apache right now 10 days, not showing too much progress, but um, 1 month there is a positive sentiment, and even 3 months. So with that, let's go to Apache and see if it's worth our attention. There you go. So let's go to the chart here. Apache, as you can see, stock is doing okay. It's above 50-day moving average, about 5-day moving average. It also looks like barely above 9-day moving average. Good on the balance volume, DMI perspective, just a bullish crossover. That's good. Only negative side is check-in money flow is indicating smart money is moving out. RSI is trying to go up. So with that, let's go into the option chain here. 137 days out, that's good. Stock is at $20. All-time high is let's see here. 52-week high is 23, which is $3 away. And if you want to play this, you could do 20, 15, 25 spread. So you could do 15, 25. There you go. So if you do something like this, you pay $4.90 here, your profit potential is $5.10. It's really double your money. Risk one to make one type play here. It's a good strategy here. So that's a summary here. So as you can see here, just to sum up, this is a strategy where IV percentile is low. As you can see here, all the IV percentile is pretty much low, below 50. When the IV percentile is low, you should be net option buyer. So that way when the stock goes up, you'll make money in that scenario. If you want to trade call or a call option, then stock has to go up for you to make money. And if you buy stock outright, same story. But if you want to buy things like say Straddle, Strangle, or even Iron Fly, Iron Condor, then you are directional neutral. Stock has to go up or down drastically, but directionally you are neutral. So those are the ideas for you to look at. And you could also do ratio spread like we talked about. You could buy more calls and sell less calls and do a ratio spread. It will also work well in this low volatility scenario. Next, let's look at one more strategy here, low IV percentile and high RSI. So So as you can see here, IB percentile itself is pretty low for most part. And if you look at the RSI, as you can see here, RSI, I made sure all these RSIs are above 60. So that means stock is kind of reaching the overbought territory. So when the stock is overbought and when the IV is low, this is when you got to be buying puts or put spread, or if you're used to it, you can also sell some sell short. But I don't recommend selling short because many folks have got bad experiences with it. But you could do things like selling put and selling put spreads. And also you could also do things like selling a call spread at the higher price. You could do that too. So with that, let's look at the chart here and see what could be good candidates. When you are selling, when you are buying the put, your direction is stock has to go down. When you're selling the put spread, same story. So for you to look at, you got to look at difference of a 52-week high also here, because you don't want to do this strategy on a stock which is at a lower price. For example, Plug Power, DDD, they are off so much from 52-week high. You don't want to go short or sell some, buy some put or put spread. But if you look at some candidates like CenterPoint Energy here, even Beyond Meat, even though they're off, they're 34%, they've gone up by 39% in 10 days. You could argue it's too much price increase too quickly. There may be a chance this might fall off. And also, as you look at RSI here, our RSI for this is 72. That tells you it's going into the overbought territory. And one more thing I highlighted is CenterPoint Energy. RSI is 67. It's at 52-week high right now, and well built, as you can see here, just 1% off of 52-week high. And if you look at RSI here, 74, which is overbought territory. And last but not least, AMC here. Right now, RSI is 85 and IV percentile is 34. Stock is 12% off a 52-week high. But if you look at 10 days, AMC has gone up 101% in 10 days because of the short squeeze type scenario. The Reddit gang is really, taken this stock up so significantly. So you don't need to short the stock, but you could do some strategies like buying put or a put spread on these scenarios. So what we'll do is we'll take a couple of stocks here. Probably we can start from bottom this time with AMC. Let me go back to Thinkorswim here. Put AMC. And let's go to the chart here, AMC chart. As you can see, your stock has shot up so nicely. Right now it's at 36.72. This is all the Reddit gang, pushing the stock up. And as you can see here, RSI has shot up to 84. And if you look at here, you can get an idea here. RSI shot up all the way up here around 85, around 94. As you can see here, stock took a tumble and came down. And now RSI is again high here. You could expect this stock to cool off a little bit. This is a strategy that or you're anticipating the stock to cool off a little bit. That's why because implied vol is low around 40. This could be a good idea to buy some put or even put spread. And if you look at on the balance volume, it's trying to tick down here, which shows it's a little bearishness at this point. And if you look at the DMI chart here, blue line is above red line, distance is big. That means right now it's in a bullish territory, and the blue line is trying to tick down a little bit. Maybe a little bit bearish sentiment, but right now it's bullish. If you look at the implied wall here, as you can see here, implied wall is trying to shoot a little bit higher. But if you see here, implied wall has gone all the way to 91, as you can see here, back in January 27. So you could argue that implied wall here can shoot up. Actually it can go down from here. Or it can go up also a little bit. Either way, it's at midpoint right now. It has gone all the way to 99 in the past, and it's gone all the way low to about 1 or around 5%. And if you look at check-in money flow here, money is smart money is trying to flow out of the stock. So by looking at this RSI here and option IV percentile is around 40, it's a good idea to initiate a put buying strategy. So for that, let's go here. As you are buying the put, you want to be you want the time to be on your side. You want to go maybe say either 81 days or 109 days out. So what you can do is, many people like to do, 81 days out. You could do that too. I typically like to go a little bit higher, a little longer. So with this $26 stock, so you could do, as you can see here, you could sell 30 25. You could buy 30 25 spread if you want. You're doing it at a higher price. So buy vertical. So you are buying 30 and you're selling 25. So let's do 25. So you're paying $4 for this spread. The risk reward is not great here. As you can see here, it's a $5 wide spread. You're paying $4 and you're making $1. So it's a risk reward is not great at all. So probably not a great idea to do this strategy at this point. Other strategy you can do is really you could try to go a little more inside. So $26 stock, you could maybe do 28 here, and 23, 28, 23. You could buy that spread. So 28. 23, it's again a $5 wide spread here. As you can see here, what you're doing is, if I go back here, you are actually buying a 28 spread, 28 put option here. So for that you're paying $13, and you're also selling at 23, which is you're paying around $9 or so for the you're actually selling it. You're bringing in $9.75. So your direction right now is stock will go below. So with that, if I confirm and send here, you are spending you're basically spending $338 to make 162 max profit, and your break even is 24.62. So you want stock to fall below 24.62 for you to start make more money. So break even point is 24.62. So this is another strategy you could employ. And if you're almost sure stock will fall off, you could also do you could buy the call option outright. So stock being at 26, you could do a 26 as an example here. You could just buy a 26 put option. You're paying $11.70, but as the stock falls off, you have max profit of $1,430. So this is other way to play. If you're not a experienced person, I would not recommend buying a put option outright. Instead, you should try slowly, try to do some spread like we talked about, and take it from there. So with that, we'll look at maybe one more here. Let's see here, well built, $24. Let's look at well built quickly and see how is well built. So well built, as you can, stock shot up. As you can see here, it's right now getting into over bought territory. Volume has also shot up drastically, and as you can see here, right now DMI chart is showing bullishness, and also check-in money, smart money is also flowing into the stock. So you could look, by looking at the chart, you could see this is a big move here. There may be some chance it will cool off. So let's quickly go to option chain here, well built. So you could also see what's going on with the well built. So well built gets a 3 point oh, you know what, this company has got a bid from another company. So when company gets a bid for acquisition, it's not a good idea to sell put or a put spread. So instead, let's go back and look at one more. So Beyond Meat. So this could be a better idea. Let's look at Beyond Meat quickly. So Beyond Meat, as you can see here, right now we are getting into overbought territory. So RSI is going above 70. Right now it's bullish, as you can see here. On the balance volume is also kind of going up. As you can see, on the balance volume went up all the way here. Stock dropped. RSI also went up. Overbought territory, stock dropped. And also here you can see, RSI is up. Stock dropped. So here also you can anticipate something similar. It's gone up so much, it can have a small drop. Smart money is going out of the stock, as you can see here. IV is 38, IV rank is 38, which is relatively low. You can take advantage of this situation by by really doing a put spread or a put. So if you look at here, why Beyond Meat, I think it's a really short squeeze, looks like. So what you can do is $145 stock here. You could do you could do 150, 145. You could do that too. That's a $5 wide spread. Or you could do 150, 140. That could be a better idea. So buy vertical 150 and 140. So so for this, you're actually paying $5.35. It's a $10 wide spread. So the remaining portion is your profit potential. So if I confirm and send here, you're paying 535 to make 465. If the stock falls, if the stock falls below 144.65, you'll start making money. So your break-even point is 144.65. Yeah, I think this is a good strategy, because stock has gone up so much drastically. You could try to see, if this works for you, and go from there. And typically, many folks probably not used to selling put spreads like this. But you could venture out slowly. Don't risk too much money. Venture out slowly. The main thing with this put spread is really don't freak out. Hold it for a while. Stock will go up and down, especially stocks like Beyond Meat will go up and down. Just have some patience, and whenever you feel like taking some profit, don't wait all the way through the end, but take some profit and take it from there. So with that, this is the entire chart here. This is basically just sum up. This is a low IV profile, high RSI. This is when you kind of employ put spread type strategies. You could also do call spread. That's one thing I did not show. Let me go back here. So Beyond Meat as an example, 145 right now. You could also when you're selling a call spread, you don't want to go too far out. You could go 46 days out and look for a little bit higher. For 145 right now, you could go all the way down here. Look at the money here. 175, good amount of money. 180, 185. So you could try, maybe, so it's a delta 18, not a bad idea. Delta 17. You could do something like this 190, 180 spread. You are selling it. So you are selling 190 here and buying back 195. So instead of 195, I would do 180. So you are selling 190 and you want to buy back. It's the other way around. So what we'll do is we'll buy 190 and sell. There you go. So you're bringing in a credit of 90 cents. So if I confirm and send this, your buying power effect here is 910. your max loss is 910, but you're making a $90 profit. So as you can see here, many of these strategies on selling premium, they always have a little bit higher buying power effect. Mainly because probability of making money here is more, because as you can see here, the delta that we looked at a chance that this will go to uh, 180 is literally low. That's why even though your buying power effect is more, the chance of you making money is a little bit higher. That's why there will be more buying power effect. So if I go back here, as you can see here, 190, if you go to 190 here, delta is 17. That tells you there is a 17% chance of this Beyond Meat stock going to 190 by by July 16. And if you look at if you look at what we sold, which is 180, 180 is what we sold, 21% here. So there's a 21% chance that Beyond Meat can go and reach up to 180. So that's why there's a less chance. That's why even though your money that your buying power effect is a little bit higher, the chance of you making money here is more. That's why there's more buying power effect. It's normally the scenario in this option premium type scenarios. Your the money that you'll hold is more. So because there's a possibility that this will be positive from a probability perspective is higher. So with that, let's go back to the chart here to sum up two strategies for you. One strategy is low IV percentile and high RSI. This is when you can bring in some premium by buying, and you can actually buy put or put spread. This is when you could really take advantage of stock kind of going down because it's already at a overbought scenario. Other strategy we looked at is really low IV percentile, low RSI. You could buy stock outright. You could buy call spread. You could also buy Strangle, Straddle as example, and you could also buy things like ratio call spread. So with that, thank you very much. Happy investing and trading. Please subscribe.